Let us now look at some of the non-resident taxation related amendments. And since these are multiple in number, instead of covering them completely in this particular video, we will cover them over the next 2 to 3 videos. And here comes the most crucial one, which is GAAR, or the General Anti-Avoidance Regulations. Now these regulations have been actually deferred. So what were the existing provision? According to the existing provision, these regulations were very much a part of the Income Tax Act in India, and they were applicable from financial year 2015-16, which is effectively 1st of April 2015. And there was no certainty in terms of how these transactions would apply to earlier investments. So let's say, for example, if there were any investments made prior to this 1/4/2015, there was no clarity in terms of how the GAAR provision would apply to them. Now, the Indian tax authorities noted that even BEPS project is underway and India is an active participant of this. So the various measures which may result in base erosion and the measures to counter them are still in the process of being developed. So considering the widespread demand of the investors and the BEPS project, what the Indian government has now decided is that the provision of general anti-avoidance regulations will be applicable from financial year 2017 and 18. And on top of that, one of the better things that has been done, which is a very welcome move, is that the investments made up to 31/3/2017. So when this applies is now 1/4/2017. And all the investments which have been made up to this date are proposed to be protected from the application of GAAR. The next amendment relates to the taxation of interest earned by a non-resident bank from its Indian PE. And these are applicable from assessment year 2016-17, which is like 1/4/2015. Now, there could be a situation where there's an Indian PE of a non-resident bank, and the Indian PE might be paying interest, to the non-resident bank or to the head office or some other PE of the non-resident. The issue in India related basically that whether this amount is taxable or not. There were a large number of judicial precedents where it was held that, payment by a PE to a non-resident bank in effect is payment to oneself, and therefore it should not be taxed. So the amendment that has been brought is that the interest paid by the Indian PE shall be deemed to accrue or arise in India, and whenever this is paid to the non-resident bank here, or the head office or the PE of a bank outside India, then the Indian PE is under an obligation to withhold taxes from such payment. If these taxes are not withheld, then the disallowance of interest payment shall be attracted. So in effect, going forward, whatever payments are made by the Indian PE to its non-resident bank, it has to withhold interest payment, withholding tax.